Welcome to Technical Tuesdays. This is Fred Razak, Senior Trading Strategist here at CMTrading. And today we're going to be discussing stop losses and take profits as our part mini-series for money management continues. But first, make sure to like and subscribe so that you could get future content like this. Now, one more request, share it. That way you help our channel grow and you allow other people to have availability to this free information. So stop losses and take profits are probably the most important element of money management. Now, there are various ways you can go about it, but I've outlined some of the most strategic ways you can go about it. And most traders who don't have a trading background and come into trading, I have to say this, okay? There is a familiarity or similarity between trading and gambling. And if you don't go in with an intent in trading, then it's very close to gambling. I'm not saying I'm going to call it gambling, but I'm saying it's going to be very close. Because the whole point of trading is that it's strategic. It has some sort of boundaries. Now, you could apply those type of boundaries in gambling and become a professional gambler. Absolutely. But if you're, just by the whip, going to Atlantic City, on a Saturday night just to have a good time, that's a different kind of play. I'm not talking about that. I'm talking about trading and intently making money and also losing money intently. Now, some people don't understand that when it comes to trading, losing is part of the game, okay? Losing is part of trading. Now, if you're losing a little bit, that's okay, okay? It's just like starting up a grocery store. I've said this a million times where, a grocery store doesn't make money on milk, sugar, bread, eggs, milk. They don't make money on that. What do they make money on? They make it on the peanut butter. They make it on the chocolate bars. They make it on the other things. But they know they got to bring you into their store. So they have to sell milk and bread and all that other stuff that they're losing money on. So in terms of trading, that's also part of taking a trade. It costs you money to take a trade, okay? And as a result, as long as you're willing to pay that cost, it's the willing to pay the cost in order to make the money, okay? But that should be the mindset that you should be coming in as a trader. And this is really very important. So some of the first elements of taking profits and stop losses is that there are boundaries. And that's really important. So one of the first ones of the guidelines that I suggest is psychological, okay? If you have $1,000 in your account, okay, and you're trading, okay, and it's going to ruin your day. It's going to literally ruin your day. To lose $1, okay, and make the account $999 instead of $1,000 because you're going from a 4 digits to a 3 digits, if that's going to ruin your day, then don't trade it. It's not worth it because it's going to just perpetuate aggravation, frustration, anxiety, stress, and all this negative mindset that doesn't help you in trading the financial markets. You have to be in the most optimal, positive mindset that you could possibly be. So if you have a psychological barrier that if you lose $1 and you go to $999 and that's going to ruin your day, don't do it. Put in another $100 and lose that $100. Or take $100 out of your account so you don't get fixated with those digits, okay? So believe it or not, a lot of people get sucked into this. And also on the upside, for example, I took a trade about 3 years ago, okay? It would have been a $60,000 trade, and I booked it at $5,000. I booked it at $5,000 because I switched the digit, and I didn't want to risk losing that digit. It was one of these type of cases. I made a 4-digit or a 3-digit, whatever it was, but I did not want to lose that digit if it was going to turn on me. I made a decision. I had to live with that decision afterwards, but could you imagine the frustration that I had afterwards, right? Where it went up. It went in my favor. For example, it went in my favor from 3 digits to 4 digits. At that point, I said, okay, I'm out. But it could have taken me to 5 digits. And I didn't take it. It's psychological. I didn't want to risk it. And so I closed the trade. It's a choice that we're making, but it's a psychological choice. And also on the downside, right? Either on the downside or the upside, it makes a difference. So number one is psychological. Number two is technical. When you're taking a trade, and let's say you're buying support, so you want to put the stop loss or the take profit either just a little bit below that resistance if you're looking for it to go higher, and that stop loss just lower than that support level, so that you're giving it some wiggle room, both on the upside potentially, okay, and on the downside that you can enter that trade. It's a very simple element. I'm just giving you a simple example of it. You could do it in Fibonacci retracements. You could do timeline also, where there's a timeline of how long you expect it to hit, okay, and if it doesn't hit that timeline, okay, then you're out of the trade. That's another stop loss or take profit that I'm just creating right now, but that is not a more boundary. That is more a time boundary, but it's not more on the account. Now, the last one is a monetary one. Now, monetary one has two elements to it, okay, and this is really important because a lot of times this is the most common type of take profit and stop loss, because it goes back to what we were talking about, the reward versus risk that we spoke about last week, the 2 for 1. You know, always looking to make double than I'm willing to lose, right? Or willing to risk, okay, which is always double, okay, because I can't, you know, risk so much money to make such little money, but I could risk some money to make much more money. That makes much more sense. So when it comes to monetary take profit and stop losses, it's the most common one because we're dealing with money all day long. So there's two types, okay? There's a fixed amount, meaning to say that if I allow myself to only lose $10 a day, okay, in my account, I could stick around with a $1,000 account for quite some time, right? I'm not going to go out of business right away. I'm going to learn the system as I have that $10 loss per day that I allow myself to have in order to create much more money. Now, on the flip side, if I'm looking to only lose, right, $10 a day, how much am I willing to make, right? The 2-to-1 ratio, looking to make $20 a day, okay? So it's always got to stick in those two elements when it comes to monetary fixed amount as either a stop loss or a take profit. Now, the last one is similar, but could be a little bit different depending on the size of the account. It's more percentage stop loss or take profit, meaning it's a percentage of your account, which is a little bit different because then you don't get caught up with the monetary amount, like in the 3 digits or 2 digits. It's just a arbitrary percentage that you're willing to, you know, look to make or look to lose at any given time. So what happens is with a fixed amount, people get a little bit too fixated with a fixed amount. So there's percentages. We'll kind of take you away from that and disconnect you from a fixed amount, dollar amount, and, you know, kind of put yourself in a psychological wheelbarrow, you know, because then it's going to ruin your whole day if it was just a little bit more than your fixed amount or a little bit less. But when you stick to a percentage, it's a little bit more leeway when it comes to a particular number. So this is really some of the guidelines that I've found really helpful in my trading when you're able to just either put yourself in a position of take losses and stop losses and take profits in the element and realm of monetizing your account in such a way of managing it that you're in control. Thank you for joining us. We'll see you here next week.